Hey, hello investors and future investors. Welcome back to the channel. My name is Tim, and on this channel, I show you how I use my portfolio in order to make weekly income. For today's video, I'm going to show you guys one option strategy that I utilize in my portfolio in order for me to get consistent weekly income. And I'm going to show you how I could use this option strategy in order to make an extra $2,600. Welcome to Investment Gains. Let's jump right into it. Welcome back, future investors, and for those of you visiting the channel for the first time, welcome to the weekly options team. So as I mentioned, I will show you one option strategy that I'm using myself in my portfolio in order to generate consistent weekly income. Now, in order for you to get good with options, there's only one sure way in order for you to do that, and that is how we say to get down and dirty with options. Now, you know how we do it on the channel. We give you an exact walkthrough of how to perform these strategies and show you the benefits, the exit strategies, everything that's going to make you better able to make an informed decision. Remember, the ultimate decision, however, is always yours. That being said, let's get straight into the strategy. So for today's video, we're going to be using Micron Technologies, ticker MU. Okay, so here we are on Micron Technologies, ticker MU, and right before we get into the video, I know there's a couple of you guys out there that watch this channel. You guys need to get away from your 9 to 5, or you guys are actually trying to make some extra income on the side. That being said, I would like to announce that I'm offering a free options training for the entire week starting this coming Monday. If this video is still up, that means the free training is still being offered. All you need to do is just sign up. The link is going to be in the description below. Now, let's go right ahead. To get this option strategy started, we first have to go, as usual, to trade MU option, which is going to be located in your lower right hand corner. What that's going to do is that's going to open up the options chain. Now, the option chain gives us enough information for us to make an informed decision about what trade we want to get into. Now that the option chain is open, we're going to go ahead and start our strategy. Now, this is a two-part strategy, so pay close attention. So the first part of this strategy involves buying a long call. So let's make sure we have it on buy and call. And now we're going to choose our expiration date all the way out. Okay, so for today's video, I'll be going with the December date. That's going to give me December 20th, and I have 127 days to expiration. Let's go ahead and we're going to select that. Now, in order for this option strategy to work, you could choose any strike date that's 6 months or further out. It's still going to work for this option strategy. Now that we have our buy and call, now we're going to proceed to choose our strike price below the current share price. I'm going to be going with let's go with the $85 strike price. As you can see, strike price up here. Now, with the $85 strike price, what that's going to allow me to do, that's going to allow me to control 100 shares of Micron Technologies for only $21.95 or $2,195. As you know, each option contract is multiplied by 100 shares. So, why would anyone want to control 100 shares of any stock as opposed to buying it outright? Well, that's quite simple. If you were to buy 100 shares of Micron right now, that would cost you $102 per share, which is going to have you pay in total for 100 shares upwards of $10,000. By employing this strategy, you're now going to be able to control 100 shares for less than a third of what the cost would be to buy it outright. And that's why someone would choose this option strategy as opposed to buying it outright. So now we're going to jump quickly into the Greeks, and that's also what helps us make an informed decision. So as you can see here, the delta is really, really important. The delta here is 0.77. I would like you to remember this for the next part of this option strategy. So now we're going to go ahead. We're going to click the 21.95. And there you have it. So this is known as a long call or a LEAPS option strategy, or LEAPS is going to stand for long-term equity anticipation security. It is a mouthful, hence the shortened form LEAPS option. So like I said, we're going to go ahead, we're going to hit continue, we're going to choose our amount of contract, which is going to be 1. So at this point, I would like to let you guys know the only difference between trading with a small portfolio and trading with a big portfolio is your ability to scale. So if you do have a big portfolio and you want to do multiple contracts of this, feel free to go right ahead. But if you're managing a small portfolio, always remember to trade within your portfolio. That means do not allocate too much of your portfolio to only one stock, ETF, or options. Okay, so now we have a leaps call into our option portfolio. What are we going to do with it? So like I mentioned earlier, I do use all these option strategies in order to make weekly income. So now we're going to utilize this leaps option in our portfolio, and we're going to go ahead and make regular income. So now for the second part of this option strategy, remember the first part was the leaps option strategy. So let's go ahead to the second part, and for that we're going to make sure it says sell and call. Now, as opposed to the leaps option strategy, now we're going to go ahead and we're going to choose a strike date a lot closer in because we want to make weekly income. Now, as you can see, I'm going to be going with August 23rd, and that gives me 8 days to expiration, which is roughly about a week. So we're going to go ahead, we're going to select the August 23rd. Now, as opposed to the last strategy, which is the leaps option, where we chose our strike price below the current share price, it is highly advisable that with this option strategy, we're going to choose our strike price above the current share price. We're going to be going with $108 strike price. And the $108 strike price is going to give me a chance of profitability of 86%. As you can see, chance of profitability up here. And it's also going to pay me 0.59 or $59. Once again, 0.59 multiplied by 100 shares. Now, why did I choose the 108 strike price? Well, for that, we're going to go once again into our Greeks. Now, hopefully you remember in the last option strategy, which is the leaps, I showed you that I acquired the leaps option at a 7.7 delta. Now we're going to choose our Greeks here at a 0.6. So the reason for that is that you need to try your best not to get assigned on your leaps option or your long call. And the reason why you do not want to get assigned is because you want to use this option strategy on a regular basis to continue making revenue. Like I said, I will show you how making regular income with this strategy is going to give you at least $2,600. So we're going to be going for delta of 0.6, and that's going to reduce our chance of us getting assigned. So now again, we're going to go ahead, we're going to click into it. And here you go. So this option strategy is known as the covered call. Now, the previous strategy is known as a leaps option. Now, this one is known as a covered call. The two strategies together is known as the PMCC or poor man's covered call. Now, the reason why it's called the PMCC or poor man's covered call is because you're able to control 100 shares of a stock for a lot less money than buying it outright, and you're still going to be able to generate weekly income. Now, we're going to go ahead, we're going to hit continue, and we're going to choose our amount of contracts, which is 1. So how do you make $2,600? Well, in my case, I like to make weekly income. So what I do is that I try to do this strategy as much as I can for the entire year without being assigned and just keep generating weekly income. Now, if you do multiply 59 by 52 weeks of the year, you will see you will come up to about 2,600 and above, providing you do not get assigned. So once again, this option strategy is known as the poor man's covered call. A couple of tidbits you need to keep in mind. Always look for a stock that's not being hyped. For instance, I would choose Micron Technologies because it is in the S&P 500, so it has an established reputation, and even better, it's not one of the technology stocks that's being pumped right now. So that's going to allow it to remain flat, and you could make consistent regular income. The other tidbit you always need to remember is that before entering any option strategy, always make sure you have an exit plan. So in option trading, what an exit plan does is that it forces you actually to do your own research. So before trading any option strategy, you will go ahead and you're going to look to make sure the stock is not being hyped. You're going to make sure the stock does not have any upcoming earnings that's going to be reported. So this is one option strategy I use personally in my portfolio in order to generate regular income. So if you guys want to become part of the weekly income team, take full advantage of this free virtual training I'm offering for 1 week. Remember, the link is in the description below. And also remember, if you guys can resonate with this type of content, remember, like the video and also subscribe. And remember, please hit the notification bell to get an alert when I post a video. And until the next video, remember, keep pushing your investments, but